Another deal that made big news last year, Berkshire Hathaway's $26 billion takeover of railroad company Burlington Northern. The initial reaction to the deal meant that 2009 saw Warren Buffett's worst performance against the stock market since 1999. Berkshire Hathaway shares advanced less than 3%, while the S&P 500 saw a 23% return. Joining us now is Bill Bergman. He's the senior stock analyst at Morningstar, covering Berkshire Hathaway. Bill, welcome to Bloomberg News. Thanks for coming on.
Hi, Mark. Hi, Julie. Nice to be here.
What happened?
What happened? Well, last year a lot of things happened. We just had the most exciting period in our capital markets since World War II, perhaps, the recovery from the worst financial crisis since the Great Depression. Berkshire itself had a modest year by any stretch, but at the same time, I wouldn't necessarily look at the Burlington Northern deal as something that was the driving factor in that overall performance. Well, 2009 was, sorry, go ahead.
No, what was the overall factor then?
Well, there were a lot of them going on. One of them, at least, I've heard the 2009 around the shop here and other places kind of derisively termed the running of the turds, where the best performing stocks in the stock market this year have been people that were the hardest hit in the economic and financial crisis. The recovery has been concentrated in the stock market in companies that are relatively less competitive or, you know, the high quality companies didn't share in the rally to the same extent that the people that were hardest hit by the crisis in 2007 and 2008.
Right.
So that's one thing that.
Well, let me point out, because in the world of Berkshire, 1 year is a short time frame. Am I correct in assuming that, at least from your analysis, it might be at least more pertinent to start looking long term as opposed to 1 year in the history of this storied company?
Sure, 1 year, and in fact, you know, we do this every year, and it's probably a good thing to take a checkup every December. But there are a lot of 1 year time horizons, and in the last 15 years or so, the S&P 500 has beaten Berkshire 1/3 of the time. But over that time frame, you've got the Berkshire has outperformed the S&P 500 by 2 times total over that 15-year time frame. So, you know, in any given year, you can have things happen, but from a longer-term perspective, one thing to note, though, that this outperformance on the part of Berkshire from a longer-term time horizon is something that's been narrowing over the last 5-10 years or so. And the managers themselves at Berkshire are asking people to reduce their expectations on that score. So, but you know, from a longer-term time horizon, the recent outperformance by the S&P 500 over Berkshire doesn't seem to be a big dramatic problem for Berkshire Hathaway.
But Bill, given the narrowing of that gap, do you think that confidence at all has been shaken in Warren Buffett and his abilities?
It may be shaken in some places, but they may not be the best places to listen to. The company itself is still led by some of the brightest, most enthusiastic and passionate people about producing shareholder value that are out there in the marketplace. It's something that we respect here at Morningstar in a great deal around our shop. There's a lot of fans for Berkshire Hathaway. Well, we currently don't have them. I don't currently have them rated as a buy, but it's pretty close. And if we look at the makeup of the company, another thing that happened last year, you look at the makeup of the company relative to where it was, say, 10, 20 years ago. The importance of these operating subsidiaries, not just the insurance operations, but the operating subsidiaries within Berkshire Hathaway has grown very important. And you've got a set of very economically sensitive subsidiaries, including a good chunk of them are in the construction and housing markets in ways that the company didn't have, say, 15 years ago. And we've had the worst housing crisis, and we've barely seen a recovery get developing in the housing market. As a consequence, looking at, you know, that's another reason why the operating performance at Berkshire, at least in the overall earnings level, wasn't necessarily something that you could have seen last year. But it could flower here in the next year or two, given the recovery that's been developing.
So do you think the stock will perform better as well, set to beat the S&P again?
It's hard to predict. You know, we try to estimate fair values, I guess, at Morningstar as opposed to predicting crowd psychology. But having said that, over the long haul, I still believe that the intrinsic value of Berkshire Hathaway is significantly higher than the current fair value, the current market price of the stock. And yeah, I do think the market's going to appreciate that over the next 5-10 years.
Bill, might I ask, in our story on a Bloomberg terminal, we quote Jeff Matthews. He's the author of the book Pilgrimage to Warren Buffett's Omaha. He said, this isn't your father's Berkshire, and he continues, it's a protector of wealth and hopefully steady growth, but very dependent on the economy in ways that it hasn't been in the past. Would you agree with that assessment?
I would agree with that assessment, but at the same time, I wouldn't necessarily cite it as a cause for concern.
Right.
The operating model at Berkshire Hathaway certainly isn't what your father saw, or my mother, or whoever. But if you look at the makeup of the companies and the distribution of insurance versus the operating subsidiaries and what the two together combined can provide for their shareholders is something that was proven viable in the recession and the financial crisis. Operating cash flow with Berkshire Hathaway in the aggregate has been rising in the last couple of years, even as the operating subsidiaries have been having reduced revenue growth, reduced profitability. They've been hit hard during the financial crisis and during the recession. And at the same time, operating cash flow for the company as a whole has been rising in the last couple of years.
And Bill,
helping to insulate the overall enterprise from the recession.
And Bill,
it's an interesting combination these days.
Bill,
it's worth looking at.
Bill, I'm afraid we're going to have to leave it there. Bill Bergman of Morningstar joining us from Chicago, talking about Berkshire Hathaway. Bill, thanks. Julie.